Hello and welcome to the Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling with owner financing. Before we begin, a quick reminder that everything shared on this channel is for educational purposes only. Every situation is different, so always consult a qualified legal, tax, accounting, or financial professional before making your final investment decisions. In today's episode, we will talk about the biggest risks for Canadians investing in U.S. real estate using the slow flip strategy. Of course, an important question because every investment carries risk. The goal cannot be to eliminate all the risk. The goal has to be to understand the risk, prepare for it, and then build systems to mitigate them. So, the first risk we will speak of is currency exchange. Your income, your savings, even your home equity are likely all in Canadian dollars, but your property and your expenses and your revenues for your US investment will be in US dollars. Exchange rates move over time. Sometimes that can work in your favor, and sometimes it doesn't. So instead of trying to predict currency markets, I suggest that you would focus on buying good properties that generate strong cash flow. Currency is going to fluctuate, but that becomes much easier to manage when you have enough spread between your expenses and revenues. And of course, as you know, the slow flip strategy focuses on a debt repayment window that is quite aggressive from the first 5 to 7 years, and then you are in the money, so to speak, in the ensuing 25 to 30 years. The second risk is really your buyer. Not every buyer will make every payment on time. Life happens, and that's why I never assume every transaction is going to go perfectly. So you have to mitigate. How do you mitigate your buyers not paying you? First, you screen. You structure every deal knowing that there will eventually be some late payments, unexpected situations, and maybe some occasional defaults. So you want to build some reserves and buy properties with good margins that give you room to manage those situations professionally when they happen. The next risk is regulation. As Canadians, we're investing in another country. So there are going to be new banking rules, new tax considerations, legal requirements, and business structures that are different from what we're used to here in Canada. So you can mitigate those risks as well. The good news is that there are thousands of Canadians who successfully own US real estate, so you're not reinventing the wheel here. The key is building the right professional team, understanding the rules before you buy instead of discovering them as you go. And you can understand those rules by enlisting the right accountant, the right lawyer, and the right team to work with you ahead of time and set up your processes and your structures. Another risk is the eviction process. Depending on your state, the eviction can take a long time. So to mitigate that, you want to pick a state that has a forfeiture process as an alternative to foreclosure. Forfeiture takes less time to redeem the property, and it also costs a lot less in legal fees. Again, here too, you want to have some reserves because while you're going through the forfeiture process, your buyer is likely not paying you and you still need to pay your own debt. Surprisingly, another risk is going too fast, scaling too quickly by buying too many properties at once. Sometimes that happens because you are excited and you're having success on your first couple of deals and you think that they will all go that way. Our advice is to pace yourself, buy and sell incrementally. Make sure that you actually sell the property before you go on and buy the next one, and also ensure that you have enough reserves overall for all of the properties that you've acquired. People often ask whether these risks keep us awake at night and should prevent us from proceeding, and our answer is no. The answer is certainly that if you have prepared for all of these risks, there is enough room and enough margin in this strategy that you can go through bumps and bruises and still come out on top in the long run. The keys, though, are preparation, having structures and rules understood by having a team that works with you, having good reserves, enough for each property, not scaling too quickly, going one at a time, filling the property completely before you move on to the next one, and also doing some level of screening. Now, we have to be fair. The opportunities we're providing here to people who could not otherwise afford a mortgage are usually for people who have bruised credits or have a difficult, challenging financial past. And so we don't want to make the screening so strict that they then don't have the opportunity to take part in this program, which is really for their benefit. So the intent in your screening is supposed to be looking at things that could be an indication that you might have trouble down the road, and finding ways to mitigate those troubles through conversations with your potential buyer. So if you see, for instance, that there's a history of short stints in employment, you might speak to your potential buyer and ask, is the current employment that they have something that they foresee staying in? If you see that there's a history of mispayment, well, you may ask if the amount that you've agreed to as a monthly payment is in fact something they can see themselves affording, or there's something that needs to be adjusted there. Really, the key is to find information so you can enter into an honest dialogue with your buyer and arrive at a consensus that they think is going to be a win-win for them and for you. Now, that said, there may be some instances when through your screening you discover that there just isn't a right fit. And the beauty of belonging to this family and this network of the Owner Finance Academy is you might find another seller and another investor in our network that has a property that's a better fit for your candidate. So if you'd like to learn more about the Owner Finance Academy system for Canadians investing remotely in U.S. real estate using the slow flip strategy, there's a link to the full course in the description. If you're not quite ready for the full course, you can download the free slow flip viability diagnostic using the link too. And for those who prefer learning in groups, you can do that by joining the free Cohort. It's an application-based program. You sign up, you get selected, and then you can be part of a group of 15 to 20 investors learning the program together and getting help buying their first slow flip property in the US. Thank you, and see you in the next lesson.